All right, folks, good evening. Let's go ahead and get airborne. Hopefully, like I said, everybody charged up a glass of wine or whatever your favorite aperitif is for a great session tonight. We're officially at halftime. So after we got it done, accelerated retirement this afternoon, we took a look at a hedge, a bullish double vertical on SDS, and also a bull put spread on Facebook, kind of a pre-earnings trade. Had a great session this afternoon. As soon as we got done, or actually during the closing part of that brief, between the end of that brief and 6 o'clock, which I started getting ready for tonight, 12 full throttle slots are gone. 10 or 11 max afterburner slots, and then 1 offensive. Okay, so that's where you need to go. Go.topgunoptions.com/getft. Or you can give us a call if you have any questions. The number is 754-300-1084. You can call now, or obviously you're in a webinar to listen to Doug. Don't call now. But you can call that number, and our customer support folks are standing by. So welcome to Vertical Spread Training, 8 p.m., 2000 for you non-military types on the East Coast. We've covered this throughout the week. I don't need to really get into the tactical items too much, but hopefully everybody by now has subscribed to my daily sit rep. So you're getting that push to you, so you don't have to go hunt around the website and find it on the blog. So head to go.topgunoptions.com/sitrep, and you can get my my daily content. There's the replay page everybody should know about by now. So if anybody comes up during the webinar and says, hey, is this recorded? I'm going to boot you out. No, I'm kidding. But everything's recorded, folks. I've been saying that until I've been blue in the face. So a lot of more people streaming into the room here. So I'm looking forward to getting airborne here. Okay. Let's go ahead and let me grab that, and we'll press forward. Yep, I just put the link up there, guys. And the first question's out of the gate, what's the link? So here's the link to grab your slot. If this full throttle will be like all the other ones, people, as Doug is talking, go, okay, this guy is not a closet case. He actually is pretty as good as Wiz says, and I'll grab my slot now. Slots will be going throughout this webinar, so just keep that in mind. And I know that some of you actually emailed support and said, hey, can you hold a slot for me? I got to, I'll buy it tomorrow, whatever. Folks, when we hit our 50, we hit our 50. We really can't play favorites there. So tonight's brief, like I said, no more holds with our customer support folks, unless you're like, hey, I'm going to buy a full throttle max, like, give me a couple minutes. If not, we got to give it to the next person. I covered our admin items. I'm going to do a quick intro, talk about some performance, and I got to get out of the way. I'm not going to talk for more than 5 minutes here because Doug's got to do his vertical spread training, and like I said, by the end we'll lose a couple more slots, and I'll give you an update there. Around whatever it is, 38 slots available. They're available right now. It's a full year. I love how each time a couple people ask, wait, is this an annual or monthly fee? I'd love to be charging $3,000 a month, and hopefully in a year or two we will be, because we've gone from what, Doug, like $495 a year up to $29.95, and the performance just keeps getting better. I showed you guys what I did last week in weekly options trades: 3 shots, 3 kills for $5,300. Goldman Sachs bear call spread, an SPX iron condor, and an SPX bear call spread that I sold as the ADP numbers came out and the market went stupid. I sold right into that pop, and we made $1,100 in 4 hours. So we keep it nice and tight, folks, because of this live training component. Doug tomorrow morning is going to get to see the Battle of Britain in the chat box here. Doug, we have like nearly 6,000 people registered for this. So in the past couple sessions, it drives instructors, good instructors like Doug and I, nuts to see so many great questions flying by, and you can't handle the capacity. So this isn't some stupid marketing trick. Doug's an Army guy, so you got to speak slowly to Doug tonight. But we're men of our word. We keep it tight for that reason. We can't have a zoo. And we drive each other for performance and self-improvement, okay? So there's the link, go.topgunoptions.com/getft. Here's what we did, folks. Welcome aboard the PLTB, the urgent alert I sent out yesterday, that double vertical on VXX. We did AR today at 1. I opened up the slots a little early. Tonight we're doing vertical spread training. Tomorrow morning, we do the demo right? Tonight, Doug's going to talk about a vertical spread, maybe a potential earnings trade. He's going to demonstrate, and then guess what? 0900 tomorrow, he going to do. Demo, do. That's how we do it in the military, and that's how you learn, okay? Somebody demonstrates, then you do it. And then Doug's also going to send out his advanced trade alert. Usually Thursday is Doug's day here at TGO, okay? And then Friday, even though the market's closed, folks, we're going to do a debrief. Doug will hop on maybe for the first 15 to 30 minutes. If you have any questions about what Doug covered tonight, what he does tomorrow that you didn't get answered, Doug will join me for the debrief at 1 o'clock on Friday, but I'm also going to cover our weekly options program then as well. And then most likely by Friday, we're going to fill up our slots and we're going to close the doors. And then if you don't grab your slot, maybe we'll see you around some other future full throttle launch. You guys know me. Don't need to get into that. Talked about last week. With everything that happened last week, all of this craziness, even just one of these news events would have been an incredibly volatile week to trade. How did we do? I told you, as I'm eating lemon chicken and sending out emails to my private coaching clients about, hey, I'd be very careful about trading Friday. I think we're going to lob some cruise missiles into Syria here. And you can see the bottom email at 9:23. I said, hey, you see the news? So that's that's obviously our highest level of service. We can talk about that after you get on board and you're comfortable here. It's called Commanding Officers Club, and you get direct access to Doug or I, and even cell phone numbers and all that stuff. But here's how we did: 3 shots, 3 kills, 1,100, 1,100, 3,300, and about $5,300 in profit in 1 week on limited risk. Remember, folks, and limited is spelled wrong. Damn spell check. It's limited risk, guys. Remember, I showed you that I have an SOP. I don't want to risk more than $5,000 on any one trade, but that's me. You could be 2.5, you could be $1,000, you could be 100 grand. None of my business. Doug and I are not registered investment advisors, so you got to cover that with one of those 500-pound heads. But I personally don't want to risk more than 5% of my model portfolio. And last week, look at that. I think the max risk was it was like 5 here, 4 here, 4,400 here. It was about 12 grandish. So let's just round up and say that's almost what, a 45% return in a week. If you're doing the math here, you're probably looking at that going, okay, wait, the full throttle max package is $29.95 for a year, and Wiz got that in last week. He paid for a year and a half of max in a week. Yeah, that's the vertical head nod, okay? You guys know me. You know my bio by now. Let's get airborne. So, folks, Doug Robertson, honored to call him a friend. He's been here at TGO almost since the beginning. Even though he's an Army guy, I'm going to call him a plank owner. A plank owner in nautical terms is if you got commissioned on a ship, you own a plank, like in the old days. So Doug's a plank owner, man. He's been our advanced instructor, and he's literally trained thousands upon thousands of TGO members since day one. He's a vol arb trader, folks. And he actually takes this as a compliment, and I mean it like that. He's our booger eater, man. You're going to get some Excel spreadsheets, implied vol versus historical. The guy he's a numbers guy. So one of the reasons Doug and I do so great together as instructors is because it's 2 different teaching styles. At the end of the day, Doug and I get airborne in our F-18s. We're flying formation. We both want to shoot down MiGs and win. But we're going to fly and fight the jet just a little bit differently, and that's the benefit you get with having a different instructor running stuff. He's a quant. Check this out, folks. He worked down the street from me on the intersection of Jackson and LaSalle there, so he did his time up in the the Chicago prison, and he was swinging around $500 million a day, that big of a book. Let that sink in, folks. That's the big deal. I think he went. I think he wised up like I did. I went to a warmer climate in Boca, and I think Doug went down to Bimini or something like that to trade as well. So, hell of a guy. He was the director of European trading up there again. And he runs a small fund down here for you have to be an accredited investor. Maybe you can talk to Doug about that on his own. So he does manage a little bit of money, but that's a one-off conversation there. And he's also our full throttle instructor. So tonight you're going to get a demonstration of the actual training of those 8 sessions that you're going to get all live. And here's the added benefit of becoming a full throttle member here at TGO. If we do another full throttle launch in, I don't know, June or July or something like that, as long as you're a TGO member here, you get free access to his training every time he does it. And I think maybe the next time around, I might do the training just because I haven't done any training in a while here, and I know some members have been asking, when am I going to get back up on the plate? I'd love to, so we'll think about that. Doug also, he runs our advanced live trade brief, which is tomorrow morning at 9, and also the ATA, the Advanced Trade Alert Service. Emails, text alerts, market-appropriate tactics, and he is excuse my French, he's a pig in shit around earnings, guys, and that's a compliment. Loves it. He's going to talk about implied, historical, the volatility crush after earnings, and he's going to show you how to maximize risk or minimize risk and maximize gain. So, folks, without further ado, that was 7 minutes, so I owe everybody 2 shots for the time that I went over. So, Doug, I'm going to throw it over to you, my friend. Ladies and gentlemen, I'm going to get out of the way. I'm going to be here answering questions in the chat box. If I can answer them. If not, Doug will answer them. So, Doug, over to you, my friend, and I'll get out of the way.
Sounds good. And let's see here. I guess I can even put the webcam on. By the way, everybody, this is something I don't normally do, so I'm not sure if I'm going to scare people away or it's going to be good. But welcome to Full Throttle Tactics. We are talking about vertical spreads tonight. So as Wiz was saying, this is one of the things that I love doing. I really enjoy teaching people, taught a lot of people over the years. Full Throttle is a great series. You know, we start out with the fundamentals, the basics of what's going on out there. Hey, Patrick, how's it going? Good to see you. We'll start out with the basics. We work from the basic concepts up through to the point where you understand the Greeks, you understand how and why options work, how we put the options together, and how we create different trades. Now, the session we're going to dive into tonight, bluntly, I don't have time to do the full thing. It's impossible. When we do a full throttle session, we take all the time we want and we dive deep into it. So I'm going to give you a little bit of a sample of what we're doing. And then I'm going to poke around with the actual market. We're going to be taking a look at ULTA and possibly EFA and exploring a couple of different ways that we can do vertical spreads. Interesting market out there right now for vertical spreads, though. I'm sure that everybody's been noticing the volatility's been pretty low, but we suddenly got a big jump in volatility in the last couple of days. So got some new things to play around with. Looking forward to some more volatility out there, and looking forward to teaching some different ways to make some money with these things. Now, I'm curious because every time we get a new group in here, I kind of like to get a bit of sense of who I'm talking to. So if you don't mind doing me a favor, type into the question and just say where you're from. This has been an informal survey I've been doing for years, and I have been talking with people from Australia, from Singapore, from pretty much everywhere. Boynton Beach, wow, Peter, you're just down the street. I'm up in Port St. Lucie, Destin, Florida, LA, Canada, Montana, Fort Myers, yep. Let's see here. Berkeley, California, Dallas, Seattle, Park City, Utah. I love Utah. Good. Love the mountains out there. I used to go and do presentations in Lehigh, and I'd go down to the Foundry over at was it? Oh God, what's the name of the place? Robert Redford's mountain just down the road there. Good place. Treasure Island, Florida. All right. Well, we get people from all over. Sundance. There we go. Yes. But used to eat at the Foundry. Really awesome place. If you're ever around Salt Lake City, I would definitely recommend heading out there and checking it out. Manchester. Oh, Martin, you've got a daughter here. Okay. Well, I live right out in Tradition. Well, it looks like we get people from all over, so very cool. Excellent. Good to see all of you. I'm glad to have you on board. So let's dive in and let's take a look at this. Now, I just want to give you a little bit of an idea. Before we ever get to this part, we've already gone through an understanding of how do we structure our trade strategies? How do we look at the market? How do we look at the commit criteria, the reason we're getting into the trade? We also have gone into a very in-depth session on understanding the Greeks and understanding how to basically read a trade and learn what it's going to do for you. So if we hit on a couple of concepts tonight that aren't completely familiar, those are things we would have covered completely before we ever got to this part. This is kind of dropping you in the middle of this series, but it also gives us a chance to actually preview a little bit about what we're doing. So what exactly are vertical spreads? Now, a quick question again. How many of you have traded bull put spreads, bear call spreads, or vertical spreads of any type? Anybody who's a regular with these at this point? Some? Okay. Credit spreads, debit spreads. Vertical spreads are kind of your go-to trade whenever it comes to directional money making in the market. The way they're set up, they take advantage of a lot of features that make options great. They take advantage of kind of natively overpriced options that's actually you're going in on the same side as the sellers. You're using their advantage to your advantage. You're creating a situation where you get a little extra edge in the market. They are tightly controlled risks, and they're designed to make money when the stock moves in a direction. So vertical spreads are two-legged option strategies, and I'll get into all the details of this in just a second, where we're using different strike prices on the same expiration date to set up a trade that's going to make money as the stock price moves. So there's actually a variety of vertical spreads, and there's some popular ones, there's some less popular ones. The ones that most people typically use are the credit spreads. These are your bear call spreads and your bull put spreads. There's a good reason why we use them. They're great trades. They can be excellent trades for creating a high probability situation where you can make money. Bear call spreads use a pair of calls to create a situation where you'll make money if a stock goes down, if the stock stays where it is, and as long as the stock doesn't go too far up, you can create a good trade with a bear call. Bull puts, they take the other side. We can structure a bull put spread to make money if the stock goes up, if the stock stays flat, or as long as it doesn't go too far against you, can still make a good full profit on it if the stock goes down just a little bit. Some of the less popular ones, and I wouldn't say that they're bad trades, but they're more specific trades. We can get into bull call spreads and bear put spreads. Actually took one of my wingman people, it's a group of people I do more intensive training with, and we set up a trade on a very, very long-term trade using a bull call spread on Amazon. And I showed him how he can actually create a trade that costs very, very little money. It doesn't have some of the better features that the credit spreads do, but in his case, he was able to create a trade that was a replacement for a long-term leap style trade, and do it for a fraction of the money and actually get a very, very good potential return out of it. We'll see how it works out, but I taught him how to use those for that. Bear puts are the bearish version of the same thing. So there's a lot of varieties we can get into when we look at vertical spreads. Now, I'm going to start out with the basics. Primarily, we're using these for directional trading. Now, once again, I'd already talked about the Greeks at this point, so I've gone in and discussed all of the different aspects of how volatility affects things, theta affects things, price movement, and delta affects things. In this particular trade, we're going to be using vega, or volatility, and potentially theta to our advantage, but it's primarily a delta trade. It is a directional trade. We're trying to make money as the stock price moves. And as I mentioned before, verticals have controlled risks and defined max profits. Peter, a little bit off topic, but do I ever trade unbalanced butterflies? If you're referring to broken wing butterflies, yes, I do. Haven't had a good environment for those for a long time because we need high implied volatility, but yeah, unbalanced butterflies, I'm not entirely sure what you mean. I'm assuming that's a broken wing that you're asking about. Okay, so what we're dealing with, out of the money credit spreads. Let's dive into this one. Structurally, it's a pretty simple trade. It's actually pretty easy to build up. You're taking two options. You're using the same expiration for both options. You're getting a net credit in the trade. You're selling an out of the money option. So if we're going bullish, we're selling a put that's out of the money. That means the strike on that option is below the current price of the stock in the market. And then we go further out and we protect ourselves with a cheaper out of the money, further out of the money put. So we're selling one and buying the other. Together, what happens is that creates a very, very tight control of risks, and it also creates a trade that we have a fixed profit that we will hit as long as the trade expires out of the money, and it allows us to basically make money from the price movement and from time erosion. And I'll show you how that all fits together in a second. The trade is typically short implied volatility. Well, not typically, it is short implied volatility. Now, for those of you who are not active options traders, what that means is that we've got a totally different element in the market for making trades work. Most people, when they come from the stock market side of things, think entirely in terms of, I want to make money by the stock going up, or I want to make money by the stock going down. Well, once we get into options, we have another element, and that's volatility. The best way I can describe this is we're using the fear, uncertainty, and doubt of how a stock price might move and how the perception of that fear changes to actually enhance a trade and make more money. So this trade is what's called short vega, or short volatility, and I'll poke around with that in a second. It allows us to get an advantage if implied volatility drops. Some of the things we're going to look for when we're setting up a vertical spread is high implied volatility, relatively high implied volatility. We'll get into that in just a second, relative to the forecast or its historical volatility. And once again, I'm going to flip over to a trading platform in a second. We're going to be able to look at this in a real life example, and I'll show you some of the elements that you want to see. We want to find a situation where a stock is moving into a clear direction. We want to know, we want to have confidence that a stock is basically moving where we want it to go. Now, it's impossible to be right every single time, and that's one of the advantages to this trade, because we can make a trade that doesn't have to be as right as another trade. I mean, let's see here. If you buy a stock and you believe that stock is going up and it doesn't move at all, what happens to your trade? Anybody have any thoughts on that one? I'll jump in because it's easy. It's easy on this one. It does nothing. Exactly. Stock trade, you're stuck in a certain way of making money in stocks. In fact, you're stuck with a certain set of odds when you're trading stocks. I mean, you can flip around the return and things like that by leveraging up and do a couple of different things, but you're very limited with stocks. If you buy a stock and it doesn't go up, you don't make money. If you sell a stock, sell it short, and it doesn't go down, you don't make money. If it goes against you even a slight amount in either of those situations, you lose money. What we're looking to do is create a trade that actually has a higher probability of success than that. So that's going to be one of the features of the vertical spreads. We want the stock to go up. If we were doing a bull put spread, we want to have the stock symbol go up. That's the way we make our money the best, fastest way. But it doesn't have to be that way. I can actually make just as much money if the stock doesn't even move. And I'll show you as we set this up, I can even figure out the odds of being successful on that based on what the options prices are. We can even win if the stock moves against us a bit. So that's one of the big advantages that we're going to get into with this trade, is actually skewing the odds in your favor so you've got a chance to win a really good return in a higher probability way than you would have with a stock trade. All right, so let's dig in here a little bit. All right, bear call scenario. I'll tell you what, the slides that we're going over are good information, but we've got limited time tonight. So I'm going to skip through things a little bit. This actually 35 some odd slides worth of information here that I would go over and cover, and we will do in the Full Throttle series. But tonight I want to kind of get through the basics real quick and then move on to showing you some stuff on the trading platform and actually getting into how these things work. So let's assume that we have a general scenario where we believe that stock is supposed to go down. We're going to be setting up our trade. Now, with the Full Throttle classes, you get all of the slides as a PDF document. You get all the details of everything, and we will cover this step by step by step. Tonight, to save money, I'm actually going to do it on the trading platform in Thinkorswim, and that way, or to save time, excuse me. Sorry, I was thinking of saving money. I'm going to work through it on Thinkorswim and give you a little better hands-on feel for what's going on. Now, let's see here. Let's flip over to the trade platform. Sitting on your hands? Yes, I don't want to be sitting on our hands. All right. Now, this is an interesting market right now. We're in the middle of a lot of different things going on. I mean, from launching missiles at Syria to wondering whether or not we're going to get into a fight with North Korea, figuring out how China's going to react to that, to figuring out whether or not we're going to get tax reform, to, the Fed, here's a good fun one. Fed with $4.4 trillion worth of assets on its book, it's going to start liquidating those at some point soon. We've got all kinds of craziness going on out in the market right now that are going to be driving things all over the place. Actually, I put out a little bit of a report on that, some notes on that at least tonight. Hopefully some of you got that. It's an interesting time to try to pick trades. You got to be careful, be a little picky about what you're going for. Tonight I'm going to use ULTA. ULTA Beauty Supply. They basically sell all those things that I have absolutely no need of because, it's a little shiny here, but I don't use a lot of hair care products, if you can tell. They're a good company, though. They've been growing, solid. They have had a bullish trend on them forever. I like it when things are simple. I like it when things are nice and straightforward, and I don't have to be too right about the trade to make some money. ULTA is a good example of that. I've got a good, solid, long-term trend. Is the trend going to fail? Absolutely. No question about it. When's it going to fail? Not sure. But until it does, I'm going to be working with ULTA and making some money as this thing moves. This right here is a really good, solid situation for a bull put spread. All right. We have a couple of things. Number one, we have a clear idea that we believe that ULTA is going to be going up. That is probably the number one criteria that you want to have when you're dealing with a trade, a clear idea of what you believe is going to happen. Number two, now this one's a little tougher, and I'm going to ask you to just kind of have a little bit of an imagination with me. I would like to see a higher implied volatility on ULTA right now, but it's not really there. Now, let me explain something about what I'm talking about here. A lot of times I have people say, oh, I want to take a vertical spread when volatility is at least 25 or 30, or I don't take an iron condor or a vertical spread unless I've got an IV of X. That's actually not the right answer. Okay? I hear that from people a lot, and I know it gets taught a lot, but it's actually not the right answer. What you want to do is you want to have a situation where you can get enough premium on the trade to justify taking the risk in the trade. The second thing that you always want to be having is a situation when you're dealing with the trades. When you want to be dealing with the trades is you want to have a pretty good ability to say that implied volatility on this particular trade is not going to radically go up. Now, I told you a second ago I'm going to need to have your, for you to use your imagination. Right now, I'm using ULTA because it gives me an opportunity to teach you a lot about the trades. Now, I'm going to be dealing with basically the market after it's closed. I'm going to be looking at the options book when it's not really full to the way it's supposed to be. Spreads are going to be wide, and there's going to be a few things about this trade that are not perfect. Listen to what I'm telling you, listen to what I'm explaining, what to look for, and understand that I'm trying to give you the best example I can given the market conditions right now. All right. So we have ULTA. We believe it's going to go up. As I said, use your imagination a little bit, and we believe that there's a decent chance that the volatility on ULTA will fall down a little bit or stay stable. What we don't want to have is for implied volatility to shoot up. Now, one of the things that I spoke about a second ago, implied volatility, and I said you don't necessarily need to have implied volatility at a super high level to make the trade work, and that's true. In fact, I'd really like to get people to change the way that they think about implied volatility relating to a lot of trades. There's an indicator that I use on my platform. In fact, I share it with everybody in my classes. And it's got a couple of pieces of information that I find really, really handy. First of all, the green line on here is just your implied volatility. That is the basics. What is the aggregated implied volatility for ULTA Salon? So there's one piece of information I like to know. Second piece of information is the historical volatility. Now, historical volatility is actually saying the same thing as implied volatility. Implied volatility says that, let's see here, implied volatility of 19% says that over a 1-year period, a 1 standard deviation range for the price of this stock is 19% higher and 19% lower than the current price. So it tells us, based on the pricing of the options, what the market believes a normal range for this stock would be over the next 1 year. What's the range over which it'll be 68.2% of the time 1 year from now. Historical volatility actually gives us the same number, but it's based on a different thing. It's based on the way the stock price has moved. So it's looking at the actual price movements and calculating out, based on the way it's been moving, in 1 year, if it continues to move the same way, it will be within 14.34% up and 14.34% down from this current price 68.2% of the time. So 1 standard deviation range aspect of kind of the statistical formulas we use. So out of those two things, what is important about that? Why do I even care? Because you're being paid to take a risk, all right? So when we're setting up a trade, and we're going to get into the actual configuring of the trade in a second, when you're setting up a trade, would you be happier to be paid a lot to take a small risk, or to be paid a little bit to take a big risk? So think about that. What would make sense for you? Would you rather be paid a lot and take a small risk, or just be paid a little and take a big risk? Well, that's what this is actually telling you. Implied volatility is based on the options pricing. Now, some of the things that are in that are things that have absolutely nothing to do with the actual risk of the stock price moving. Things like the guys on the options floor want to make money. They don't show up to that job to basically break even. So they're selling options at a price higher than what they believe the risk is. They're not going to do the job if they're not getting paid for it. There is a lot of people out there buying up options, long-short hedge funds. They're buying these things like crazy, driving the price up because they need to protect themselves, because they lose more money from their portfolio going down and losing, because they lose customers, than they would have actually lost from paying for the options. So it makes a lot of sense for them to buy up a bunch of options. So it drives up the price of the options, and this is something that's going to drive whether or not this trade is a good thing. Now, if we figure out what we're getting paid based on the implied volatility. The risk we're taking is very, very tied to historical volatility, because this is what's going on. The stock is moving. How much is it moving? Well, we need to figure out, are we getting paid enough to take the trade so that, you know, if in case it moves this far, we won't lose money. If the stock's not moving much, our risk is lower. If the stock is moving in a more controlled way, our risk is lower. So we want to find all kinds of opportunities where we're being paid very, very well to take a risk that's actually low. So that's going to be an aspect of all the different things we're looking at here. Now, there's a final piece in this indicator that I like to show people, and this is part of my getting people to rethink implied volatility. And this is kind of leading into where we're going to go with the vertical spreads. Every single trade out there, every single stock out there has a natural range for its own implied volatility. The people trading the options understand pretty clearly how a company trades. They understand the risks. They understand, is it a well-managed company? Does it have a lot of industry risks? Does it have a lot of, is it predictable? Is it what is it? What's the company like? Now, there's some companies that are utterly boring. REITs, oil pipelines. I could tell you what an oil pipeline's P&L or earnings are going to be probably 2 years from now. REITs, for the most part, unless we have an absolutely massive housing crisis or something like that, probably pretty stable. They're designed to be that way. They're going to be boring. They're going to naturally have a smaller range of implied volatility and a lower implied volatility. Something like high-tech stock, especially high flyers, you know, maybe a cybersecurity stock, something like that, or a pharmaceutical stock with a brand new drug. Those are going to have a much higher range and a much higher implied volatility. Those are natural. They're good. That's the natural range for that symbol. But implied volatility varies within that range. And there's a kind of a natural midpoint in there someplace. You never know exactly where it is. But think about it as the implied volatility drops, it's an elastic band that stretches out and stretches out, gets tighter and tighter. It's harder for it to drop much further. And finally something happens and implied volatility jumps up. Or implied volatility goes way up and it stretches in the other direction and it falls back down. We can use that to figure out where implied volatility is most likely going to go. So I actually look back over the last 400 days of implied volatility and figure out the percentile rank for where the IV is, and it tells me, am I at a low volatility for that symbol or am I at a high volatility? ULTA is, let me see here, a low implied volatility is about 12. That's actually right down at the absolute bottom. High might be up here, 43. And where it is within that range tells me a lot about where implied volatility is likely to be as the trade moves on. Now, right now, we're in a pretty low percentile. We're in the 12th percentile. Only 12% of the time in the last 400 days has implied volatility been below this. Normally, I would take that as we've got more chance that the implied volatility is going up than down. But we're going to look at it from a different angle tonight. We're going to set up a vertical spread on this. All right, so there's the environment. There's the situation. Ray, basically it looks like when historical volatility is below IV, the historical and IV tend to move higher. It's very rare for the market to let implied volatility go below historical too much, because this is really what you get. If implied volatility is below the historical volatility, the measurement of how the stock is actually moving around, that means that there is some broker out there, some market maker who's selling the option for below the risk price of the option. It's like a car dealership selling the car for less than they bought it for. It's a dumb move. There are situations where people get forced into that. There are situations where implied volatility will drop down to a relatively low value, but it's usually very temporary, and it jumps right back up. Because if you continue to sell, actually here's a description of option sellers who sell options at a price that is effectively below the historical volatility of the stock. Broke. They are no longer traders because they lose. So implied volatility is going back up. You'll see it's pretty rare for it to stay below that for very long. Now, there are things that can affect this, like this. You see this one big day, that jumped my numbers up a little bit, and actually it probably should have been trending along here. We can talk about that more in detail when we get into class. So we've got the situation, we know what's going on, we know the environment, we know what we've got to work with. Let's go play with the options. VVIX is way up. Any concern? All of those things, to be honest with you, you've got UVXY, you've got a ton of different things. When I'm looking at a trade, I'm looking at the stock itself. That's what's important to me. I want to know what the situation with the stock is. We want to know what the environment is. And to be honest, let me see. I don't follow VVIX much, so I am CBOE VIX volatility. Okay, I just use the VIX myself, so Am I concerned about that? To be honest with you, I've been more concerned about this back here. You know, when we're down, when we're pulling lows on the VIX of 9.9, that is horrible for the market. That is not good. I am much happier with it up here. This is a good thing. I hope it actually gets a little jostled around and stays up there. Let's go back to ULTA. Let's dive in on the trade. Okay. Question for you. For all of you people out there who do vertical spreads, what's the normal time frame that you work with on vertical spreads? Six weeks? 2 weeks or less? 1 month, 60, 30 days? Sometimes a week? Okay. What we're going to do is we're going to play with that idea for a second. We can make some pretty good money on short-term vertical spreads. We can make some really good return on investment. But there's some trade-offs we get into. And I find that as I'm going through the training, a lot of people don't actually understand what these trade-offs are. So I'm not going to tell you to do long-term vertical spreads. I'm not going to tell you to do short-terms. What I'm going to tell you to do is understand what you're getting when you do each of those so you know what you're dealing with and you can make a smart decision. So let's dive in and build out our first vertical spread. We are going to do a bull put spread on ULTA. Now, here is my thesis, my commit criteria. Why am I doing this? Because I believe that ULTA is going to stay going bullish for the near future, and that while it's doing that, I want to create a trade that is going to make money as the stock goes up. In this case, I'm going to start out with a 9-day long vertical spread, bull put spread. Now, one of the things that I'm going to do is I need to figure out how to set this thing up. Now, we haven't covered Greeks yet, so you haven't gone through this class, but there's an interesting thing. How many of you look at delta? Always. Good. Now, have you heard delta described as a proxy for probability of being successful or probability of a stock price being at a certain point? All right. Here's an interesting thing. Delta is actually two different things. This number, delta, it says for every $1 price movement in the price of ULTA Salon, the option price is going to change by X. So I have a put option. And by the way, this is always termed in $1 up. So if ULTA Salon goes up by $1, the price of this put option right here, which is a 282.50 strike put that expires in 9 days, is going to change by 42 cents. It's going to drop in value by 42 cents. Well, that makes sense because a put option makes money when the stock goes down through its strike and goes down. That allows you, basically, it's giving you the right to sell a stock at a price that's high. 282.50 would be higher than the current price of the stock. I could make money on that. So the lower the price of the stock, the higher the price of the options, the more valuable they are. If the stock is going up by $1, then this option is going to lose value, 42 cents. Now, what's interesting about that is all the formulas that go on behind this are all based on the probabilities of things happening. So that actually gives you a second piece of information. Tells you what is the probability that the stock is going to be in the money on that option at the expiration of the options. So this 42 cents can also be read as a 42% chance that ULTA is going to be below 282.50 on April 21st at 4 o'clock. So that's a pretty handy piece of information. It also allows you to do something kind of neat. It allows you to create trades in a very structured way that's very, very consistent. So one of the things that I teach is to understand how to set up a trade around a delta. In this case, I'm going to use a 20 delta, which means that I have a basically a 20% chance that the stock is going to be below the short strike I'm choosing in this case 277.50. I'm going to go short on this and long on this one. So this is our bull put spread. We have a 277.50 short put and a 275 long put. Now let's take a look at a couple little things here. 277.50 short put. I wish we had a tighter spread. Normally I'd encourage you to do something with a tighter spread, but market's closed right now, so not much we can do about that. When we sell this option, 277.50, we receive a value for it or a price probably about halfway between these two numbers. It's the bid-ask midpoint. The problem with this is that this has got a completely uncontrolled, unmanaged risk. If the stock, since we're selling this, we are at risk if the stock goes down because we owe the person, they've got the ability to sell their stock to us at 277.50. And I might need to sell it at the market, which could be radically below that. It's not a good trade to just do a short option. It's called a naked option. It's very risky. It's uncontrolled. It doesn't give you control over what's going on. So what we're doing is we're going a little bit further out, down to 275, and buying a long option. Suddenly everything changes in this. From a completely uncontrolled, highly risky trade, I suddenly controlled everything. Because if the stock goes down past 277.50, this short option is going to be losing money. As it goes, though, the 275 is going to be gaining money. And then once the stock drops below 275, then this long put is gaining money just as fast as the short put is losing money, and you are completely controlled on your risk. You cannot lose any more at that point. So that's the way that these two trades work together. Now the goal for this trade is to have the short option and the long option both expire at the end of their life, which is in 9 days, worthless. And that means that I get to keep whatever credit I received on the trade in the first place, and I've lost whatever debit I had on the long option. Between the two, I end up with money in my pocket. I end up walking away with a profitable trade. And a few minutes ago, we were talking about how stocks basically have to move in a direction to make money. And in reality, it's pretty much a 50-50 shot. I mean, I'm assuming that you're good at picking out what's going on with the stocks and you understand what's happening and you're trying to give your stock trades a little bit of an edge. But, in reality, you're dealing with a bit of a chance that it's going to go up and a bit of a chance it's going to go down, even with the best situation, the best pick. With this trade, we are actually setting up a position where we're going to make money as long as ULTA stays above 277.50. Now, ULTA is currently trading at 283.78. Now, getting back to the delta, this right here is actually doing a little calculation based on how far away the stock price is from, or the strike price is from the stock. And it's saying that there's an 80% chance that the stock price is going to be above 277.50 at the expiration of this option. So that means in this case, instead of having about a 50-50 chance of the stock trade winning, I have about an 80% chance of this options trade winning, a much higher probability. We use the deltas in a lot of different ways in this trade. One of them is to figure out the probability of success. The other one is to figure out roughly where we want to put our strikes. I'll get into that in just a second. It's a good way to understand what the risks and the potential rewards of the trade are. So let's take a little deeper look at the trade that I just set up and figure out whether or not this makes sense. Jay, yes, and absolutely, and not pay a commission to close it out. We'll talk about commissions and costs in just a second here too, because that can definitely be a significant part of your trade. So we'll play around with that, but we're going to try to take this step by step. Just to give you an understanding of how I like to do this. I like to get the fundamentals down, understand the basic concepts, how and why we're doing stuff, And then I want to take us to the next level of this is the other things that you need to look at. You know, once you understand the core part of the trade, you need to understand how things like the spreads can affect you. How are things like the commissions going to affect you? How is the time of the expirations going to affect you? All of these things eventually come together into a full understanding of the trade. But you need to understand the basics of it first, the very basic concepts. So right now, let's go in, take a look at the absolute basics of our 275 by 277.50 bull put spread on ULTA. That's going to expire on April 21st. So when we're setting up this trade, we need to figure out some pretty basic things. First of all, how much is this thing going to cost us? That's a pretty fundamental concept. And when you get into options, it does get a little bit more difficult, but it's not that hard. You want to know how the brokerage figures out how much they're going to charge you for margin or a debit, whichever. And by the way, it's funny when people get all uptight about margin versus debit and things like that. The reality is it comes down to one basic thing. How much is the brokerage going to take out of your account that you cannot use for other trades to allow you to do this trade? Whether it's a debit or whether it's margin doesn't really matter that much. So in this case, let's figure out what the margin on this trade is going to be. And each trade has a little bit of a different calculation for it, but it's easy enough to learn the patterns. We have a 277.50 short put and a 275 long put. There's $2.50 between these two. All right, that right there defines the max risk on this trade. And that's what the brokerage really cares about. You want to know what margin actually is? You know, when you break it down to what margin actually is, it is the brokerage covering its butt in case you mess up. And that's it. That's fundamentally what margin is. They want to know that they've got enough money in hand so that if you do something bad or if you just get caught in a bad trade or whatever, they're not left hanging paying for your bad trade because they are on the hook for any mistakes that you make. In this case, as the stock price goes below 277.50, that short put is going to be losing money. The long put here is going to be gaining money until finally the stock goes below 275 and the long put gains money just as quickly as the short put loses it. Therefore, the two neutralize each other and you don't lose any more. So what ends up happening is the max risk that this trade has is $2.50, the difference between these two strikes. So that's what you start with. Now, to take this trade, we're actually being paid 40 cents. So we actually have a margin of $2.50, but we're already receiving 40 cents. So the real cost to us is $2.50 minus 40 cents, $2.10. This is the margin of the trade, and this is also the max risk on the trade. Should we let the stock go right through 275 and let it expire at the end of the trade? We don't want to do that. We don't ever do that. But $2.10. Now, what does $2.10 really mean? Every option, or at least the majority of options out there, represent 100 underlying stock. So what we're really doing is multiplying that times 100. So 210 times 100 means that for every one of these bull put spreads we put on, it's going to cost us 210 bucks. Flip side of that is, if this trade goes to the end of its life and it has not below 277.50 and basically anywhere above 277.50, we keep the entire 40 cents credit to ourselves. That's it. We basically let the trade expire. I have a trouble calling it worthless because that's actually the good thing. It sounds so bad when I say we let the trade expire worthless. We let the trade expire and keep the full credit. That 40 cents, now 40 cents times 100 is actually 40 bucks. So if we're holding on to this trade for 9 days and we have an 80% chance that ULTA is going to be above 277.50 and we're going to make $40 for investing or locking up $210, what does that mean to us? We're making a 19% return. Now, this is always the point where I find somebody out there always asking me the same question. So I'm going to just jump in and answer it. Well, why would I ever take a trade where I could lose $210 and only make 40 bucks? You're not thinking about it right, because your odds of winning this thing are actually, honestly, they're not even 80%. They're higher than 80%. I'll explain that in a second. And even if we lose on this trade, it's not like we just lose the $210 and it just poof disappears. I don't think I've ever taken a trade that even when it was losing, lost every single cent in the trade. You know, we're not going to be dumb traders. We're going to have a plan for managing it. We're going to have a plan for getting our profits. We're going to lay out how the trade works. We're going to control it. So we are not actually risking $210 to make 40 bucks. We are controlling the trade, having a high probability of success, and we're risking far less because we are going to put in a risk management plan that is going to control how we lose the money if we let it get that far. Plus, we've got an 80% chance of success, which is actually not even the right number. Once again, I'll explain that in just a second. Let's see if we can answer some questions here. Yeah, 988% annualized return. That's not bad, isn't it? So let's just take a look at that. And by the way, one of the other things that I like to do that's a little bit different from other people, I like to think of my trading a bit differently, and I like to get some numbers that help me think about it that way. Do we care about ULTA Salon? Do we care about winning against ULTA? Now, I want you to think about that for a second. Yeah, obviously, we care about winning trades. We want to win trades. That's what we're here for. We're here to make money. But, really, ULTA has very little to do with it. It's just an opportunity for us to use tools to make some money. What I want to do is I want to, kind of distill my trading down to one core idea. I am here to use my money to make money in the most efficient and effective and, managed risk way possible. So the trade isn't really me against ULTA. It's the risk in the trade versus the profitability in the trade and how long it's going to take to get that. So I want to know something. How well am I using my money to make money on this trade? So I've got roughly 80% chance of success here. I've got a 19% return, and it's going to take me 9 days to get there. So divide by 9. I am making a just about 2.1% return per day on this trade, which, yeah, if you multiply that times 365, you get, let's see, 772% return. Now, let's be real. We're not making 772% return based on this trade this year. We're making a nice, quick, fast profit and making a good trade. Now, I mentioned something before. Yeah, our money, that's it. We want to make money. And it's funny because you might think that what I said was silly a second ago, that I don't care about ULTA. And I was trying to make a point that I don't care about ULTA. The reality is there's a lot of people who trade, whether they realize it or not, they care about ULTA. How many times have you heard somebody say, this trade's got to go up? It's definitely has to happen this way. Or they actually act like it's a fight between them and the symbol. Or the trade's failing and they've got to win, so they're not gonna let themselves lose. I'm gonna roll this out and roll this out and roll this out. Now, I'm not against necessarily rolling out or doing an adjustment or something like that, but I don't care about winning against this symbol. That's not my goal. ULTA and I do not have a personal grudge match. What I want to do is I want to figure out the best possible way to make money. And that's a very different answer than I am going to beat ULTA. So think about that for a second. Actually, think about how that affects your trading. A lot of times when people make decisions, it's because they don't want to lose on a trade. It's not necessarily getting you the best way to make money on a trade. You want to figure out the best way to make money. All right, so a minute ago, I was describing Delta, and I was Hold on here. I'll touch on all the questions here. By the way, there's a lot of people in the room tonight, and I'm trying to cover questions, but man, there's things rolling by fast, so I'll do my best. I was talking about delta a few minutes ago, and I was saying that a 20 delta basically says there's a 20% chance that the stock goes below 277.50 or is below 277.50 at the expiration, and it is an 80% chance it's higher than that. Now, that right there is a great way to analyze the trade. It's a great way to look at the trade. It's really good information in a lot of ways. It's also wrong. And let me explain why. This number right here is calculated based off of the premium on the options and basically the implied volatility that is attributed to these options. Let's jump back. A few minutes ago, I showed you the volatility on the chart down here, the green line, and I showed you the historical volatility. Now, implied volatility, which is driving that 20% number that we saw just a second ago, is entirely based off of the price of the options in the market. And you remember when I said that these people selling the options don't sell these things as a charity. They're not there to, hand away, give away money. They're there to make a profit. They've got to pay for their house. They've got to pay for the food. They want to pay for that trip down to the cabin at the lake. So they're not going to sell the options at a price which is equal to the risk. They're going to sell it at a price that's higher than the risk. Well, how do you get a sense of generally what the risk is versus what they're selling it for? Well, you can take a look at historical volatility. I don't know, this is probably a bad use of science here, but kind of thinking along this way is the way a stock has been trading is likely to be, or the way this stock is going to trade in the future is very likely the same way it has been trading in the recent past, unless something comes along and changes the way the stock trades. Now, we can look for risks, we can look for different changes in ideas and perceptions, but for the most part, unless something big comes along, stocks will tend to do what they've been doing. Newton's law of motion for stocks. So if the risk is actually down here and the premium is up here, what just happened is this. That delta that's 20% is actually high. We are looking at this based off of that, all the prices with all of the extra, profits built into it, with everything that the sellers of the options can get built into that. That number right there is actually high. So if I look at this and say this is an 80% chance of success, that's actually not true. What it is the options are implying it's an 80% chance of success, but the way the stock is moving is actually a lot less, which means you have a higher probability of success. That right there is getting right back to the question I said before. Would you rather get paid a lot of money to take a low risk, or would you rather get paid little money to take a high risk? We are in a situation where we are being paid extra money to take a low risk. And that's one of the things you want to be thinking about. That right there, the difference between implied volatility and the historical volatility, gives you an indication of how much extra money you're getting paid, or in the options market, we like to call it edge. What's the edge you're getting in the trade? And that's actually putting you better than that 20% or that 80% success probability here. So just something to think about on that. Let me hit a couple of questions and see if I can figure out what's going on. With these thin stocks, you won't always get the 40-cent credit that's on the screen. Rick, ULTA is absolutely not a thin stock. I trade it all the time, and ULTA is very tradable. There are a lot of thin symbols out there. By the way, part of what we're seeing here is that it is after the market's closed, and going into the close, things thin out. It's just giving us a bad snapshot there, but ULTA is absolutely tradable. Also, another thing to realize, you're not wrong, by the way. You absolutely should be considering that. And if you've got symbols that are very, very wide spreads, There are a lot of cases when they're not tradable. So pay attention. ULTA is not one that I would worry about too much for that. There's a second piece to that. The bid-ask spread is not something that's an absolute value. 20 cents or 40 cents here on ULTA, which is a $283 stock, is not the same as 40 cents on something that's a $15 stock. The higher the price, the less a wider bid-ask spread means something, and the more likely you're going to get filled in the middle. I do like things with a lot tighter spreads, and normally would like to see that, but understand it is a little bit of a sliding scale. All right, one of the other questions was good. If the share price goes below 275, what happens? All right, let's actually flip over to an analysis of this trade. And hold on. That's not the right trade. There we go. Okay. There. Okay. What happens to this trade as the stock price moves? So let me see here. Laura. All right. Your throat gets a little dry as you do this stuff, by the way. Okay. The real question, actually, I'm going to expand your question a little bit, is what happens to this trade both as time goes by and as the stock price moves? So here we're looking at the options analysis screen. This tells us a lot about what's happening. We've got two lines on here. One is the blue line, and I'd call it, I don't know if everybody calls it this, but I call it the terminal P&L. This is the P&L at the end of the trade. So in this case, let me see, let me clear out this. On April 21st, depending on where the price of the stock is, this blue line tells you what the P&L of the trade is. So if we are at 283.78, we are going to be making, let me see, $400 basically. Here, I'm going to, there, let's turn it into something a little bit more interesting. You can always scale a trade up and down. So if we took 50 of these, we'd be making about $2,000 all the way down to $277.50. Now, this is at expiration. So if we had the stock drop below, and this is 4 o'clock on April 21st, if we have the stock drop below 277.50, we're going to suddenly be losing money. You can see this line starts to go down. And it's going to go down and down and down until finally our max loss is somewhere around, I'd have to figure out the exact number, but a little over $10,000. That's if we go below 275. So your answer about what happens if we go below 275 is if you leave it on to expiration, you lose the entire amount of your margin. Now, we don't do that. That's not the way we actually manage trades. And I wouldn't expect anybody to do that. The reality is the purple line. This is the line we're kind of living with between now and the expiration. So this is, let me see here. This is what the P&L looks like today. Now, remember, we just have to have ULTA stay above 283.78. ULTA has been in a very nice trend. In fact, give me a second here. What was that straight? 277.50. Let's take a look at this. Okay. I call this my sniff test. I'm just, basically playing with the trade, seeing if it smells good or doesn't smell good. It's a handy thing to do. You just want to, hold on. There we go. You want to see whether or not it's reasonable that your idea of the trade is going to win. So this line right here is 277.50. If we go below that at the expiration, that's when we start losing money. Now, we have to have the price of the stock stay above this line between now and April 21st. So here, let's just make it obvious. There. There we are. Can we get from here to here, staying above here? There's your question. Now that's the one that you have to answer to make a judgment call as to whether or not this trade is a good, decent, smart move. And this is not getting terribly analytical. This is not getting into anything else. Just visually looking at it. Do I believe that this symbol, ULTA, as it's been trending up, is going to stay above this line between here and here? Okay. If it goes below here, we start to lose money at the expiration. But between now and then, that's when things get a little tricky. So let's go back to the analysis and show you between now and then. If I have ULTA start going down in price, maybe drop a buck or two, or let's see, yeah, there's about a buck. The day that I put this on, you'll notice that the slope of the P&L here is going down. I would actually be in a loss at this point. Every day that passes, I'm going to have my options erode towards zero more. Now, the nice thing is I've got a lot of credit in there. The credit is higher than the debit, so eroding towards zero actually ends up being a very good thing. So let's watch this as we go forward in time. Each day we go forward, the P&L moves up. So if I stay right where I am, I'm actually increasing my profits every single day, even if the stock doesn't move up. In fact, my break-even point has dropped all the way down to somewhere around 280.40. We go a little further, and boom, done. Here we are at the expiration. So every day as the price of the options erode down towards zero, because as time passes, an option becomes less valuable, it means we're keeping more and more and more of that 40-cent credit in our pockets. It would cost less to close the trade, to buy it back and shut everything down, and we are making money. So that's the game we're playing here. It's a game of time and price movement. All we have to do is make sure that this price stays above here for those number of days, 9 more days. If we go below that, we lose money up to the max loss, which is $210 per position that we put on this. All right. Let's see. Bob, what is my basis for selecting ULTA for a vertical spread? I actually went through this entirely earlier. We've got a long-term solid trend. I would bluntly like to see more implied volatility in ULTA. It would make a better trade for us. I didn't have that. I needed a clear example. Now remember, I'm not telling you to run out and do ULTA. Tomorrow morning, I will analyze this trade live in the ALTB and see if it makes sense, and we may put it on in our portfolio. I'm not going to do that until I have live data in front of me and I can work with this thing. But I needed a good example, and it's a nice, clear example of what's a good situation for a bull put spread. Remember, you're learning right now. Tomorrow, we're doing. So here's the trade. We now have the ability to leave this on, make money, and ideally have the thing expire for full credit on the 9 days. Now, we've got a couple of pieces that we're playing with here that we haven't touched yet, but I think this gets the core idea of the trade. Let's see, answer a couple of questions here. Ray, since IV and historical are both low relative to historical, would I expect volatility to increase? You actually got it right. There's only 9 days in this trade, so I'm not worried about that too much. And honestly, implied volatility means nothing at the expiration. If we're looking at a trade like this one that we expect it to expire, then implied volatility doesn't really mean much whether it goes up or down. On a longer term trade that we might be getting out early, implied volatility increasing can actually hurt the trade, and you want to be very careful of that. So it's more significant on a longer term trade. Would I like to have more implied volatility in this situation? Yes, I actually would. That would be a very, very important thing. It would be, I wouldn't say it's the critical factor, but it's an important factor. And yeah, I'd like to see that. But once again, ULTA is giving us a good example of a good opportunity for this trade. Ken, for defense, do I back ratio if ULTA were to drop? Okay, you get to trigger one of my my favorite rants on this subject. Okay? We're going to take a little side trip down the do you fix your trades road. I'll try to get the other questions in here too, but once again, I got a ton of them. Every time we take a trade for a reason. And I strongly believe that you have to have a core, fundamental belief in something that's going to happen to take a trade. Now, it might be price movement. It might be the fact that it's going to stay stable and just trend sideways. It might be something totally different like volatility changing or something like that. But you have to have a reason to take the trade. In fact, I would say that the only way you get get the edge in the trade or getting an advantage in the trade is clearly understanding the reasons for how you're going to win in the trade. Now, let's say that we have something that changes and it causes you to fail. My belief was ULTA was going to maintain its trend and go up. And suddenly ULTA starts going down, and I start looking around, and I realize that something has changed on ULTA. Or maybe just the perception of ULTA has changed and the market is going in a different direction, or whatever. What that just tells you is you were wrong. So, and by the way, I'm not trying to be a jerk about this. It's the reality. Don't hide reality when you're trading. You need to face it. The fact is we were wrong. You want to be putting your money to work in places where you have a high level of confidence that you're right. Now, if you've just been proven that you're wrong, what makes you think that you are going to make a radically better decision than, by changing the trade around to maybe do it slightly differently? Do you have more information? Do you understand better where the stock is going to go? Do you understand, what's going on? There's a flip side to that too. When a trade starts failing, we're human beings and we get mad. We are pissed off. At least I am. I don't like losing. I can't stand losing my trades. And when a trade's failing, I get upset. I've never once seen a situation where strong negative emotions help you make a better decision about a trade. So, the final piece of that whole thing is anytime you talk about repair strategies, what you're talking about is, in truth, not repairing a trade. You're not fixing anything. You're closing a bad trade and you're replacing it with effectively a brand new trade that you hope makes money to offset the loss that you just had in ULTA. You're now getting away from your goal. Your goal isn't to beat ULTA. Your goal is to make money. Do you really care that you made money against ULTA and you won and it makes you feel better because you beat the stock? Or do you care that you have more money in your account? If I care about having more money in my account, I very often think that the smartest thing to do is find the safest, most solid trade I can possibly find, close out my bad trade, and move my money to a place where I can make a better return. I can make a better trade. I'm not saying that every repair strategy is wrong. It isn't. But you really need to go into it looking at the situation from the point of view of what is going to give me the best possible advantage with my money, and not the situation of I happen to be in ULTA and I'm going to try to do some things to make the trade better. Because adding more options onto an already bad trade rarely ever makes the situation better. Extending a trade where you don't understand what's happening rarely makes the situation better. Closing the trade and using that money in another place where you've got a lot more confidence about the results absolutely can make things better. So that's the things I like to encourage people to think about. I'm not telling you no, never repair the trade, but look at the trade that you're going to end up with as a brand new trade and ask yourself very clearly, is this the best possible way I can use my money? There you go. So that's one way of looking at it. All right, let's see here. Ray, when you're wrong, you get out. At what level do you get out? All right, there's a good question. That actually comes down to risk management. We'll touch on that in a second here. I got to kind of pick this up. I'm not supposed to give an entire class tonight. I'm supposed to give you a sample. We put together a risk management plan on trades. every trade has a couple of steps that we look at. One of the pieces is what I refer to as an eject point. It's effectively a stop loss. We build, and you can adjust where the stop losses are. In a lot of cases on a trade like this, I would use about a 40% loss as my stop loss point. I use that for sizing the trade. I use that for controlling my risk. I use it for a lot of different things. What I don't want to actually do is use it that often to get out of a trade. When you hit a stop loss or an eject point, you basically let the trade get to a failure point that's further than you probably should. One of the things you always want to be looking at is the fundamental reason for the trade still valid? Now, on a 9-day trade, it may not have a lot of time to do this. In fact, I'm going to show you a different trade in a second, which could give us a little bit better of an edge in this. But on a longer trade, you always want to be evaluating the question of the reason I took this trade was X. Is that still real? And if the reason for the trade goes away, I don't care where you are, at a profit, at a little bit of a loss, not hitting your stop loss, whatever, if the reason for the trade has clearly gone away, you close the trade. If you've got money in play and you don't have a reason for it to be there, you're gambling. That's it. You are rolling the dice and hoping you win. That's not a good way to make money. If you want to be using your money where you have a clear advantage to make a profit. So one of the best ways of actually managing your losses and managing your risks are to have a review process that says, I'm going to check the trade. I'm going to review why I took this trade. And I'm going to clearly ask myself, is the reason for the trade still valid? And if I say no, I close the trade. And that's not a price level. It's a philosophy. It's something you got to work on, but it's something that you can build into your trading and actually does help you quite a bit. We do have eject points, and that's just to prevent us from being dumb. Sometimes we get hopeful, we get wishful, we get all kinds of those bad things, and it hurts your trading. The eject point is there to say, stop thinking and just get out. That's another control that you have in your trade. We build those into each trade. In fact, sometimes we build a lot of them in. All right, let me dive back into the trade again. I'm sorry if I'm missing your question. I really do try to get these, but we've got tons of people here tonight. Let's see. Joe, if I'm getting out, I would close the whole thing. Lock, stock, and barrel. I'm not trying to hold on to bits and pieces. You could if you wanted to, but it comes down to the same question I had before when I talked about repairing a trade or adjusting a trade. Is the trade that you are left with a good trade? If you can say clearly, yes, it is, it's a good way to use your money, great, leave it on. It's pretty rare that's the case, though. It's pretty rare that remnants of a trade are a good trade by themselves. So most of the time, it's shutting the trade down. The bonus to this whole thing is it actually makes your trading simpler. You don't need to put on all kinds of convoluted, adjust it this way and tweak it this way and do this and do this. You've got a reason for the trade. You know how it's going to work. You know how you're going to manage it. You do it. If it doesn't work, you close it. You move on to the next trade to try to get the edge there. It's nicer and simpler to do it that way. You are actually reducing the complexity in your life. All right. Let's take another quick look at this trade, and I want to point something out. This trade right here doesn't look like that bad of a trade. We're getting paid very, very well to take it. Problem is that this line right here is awful close to the price that we've got right here. Now, I think that this is pretty decent. I think that we've got a decent amount of room, but we could have, well, this was an earnings announcement, so that's probably not a great example. Let's say that we have this right here. See these 2 days where the stock price goes down here and then down here? If you move those 2 days over here, that would go right through this line. That represents a problem for me. Short-term vertical spreads are generally more sensitive to quick price movements in the market, and they put you at a higher risk. We're making almost 2% a day on this trade. That's really good money, but we're doing it because there's a risk there. We're getting paid to take a risk. Now, it may not seem like 80% chance of success is that bad of a risk, but there's also a component of this where if this moves very, very fast, we may not be able to manage the trade very well and maybe go and hit our stop loss potentially even worse. So how do we fix this? Now, this is the discussion I wanted to get into about what's better, short-term vertical spread or long-term. Short-term vertical spreads pay you very, very well, but they have a very specific risk that the strikes you use are typically much closer to the current price of the stock and more sensitive to quick movements of the market against you. So let's go and set up a slightly different version of the same trade and just compare what you would get in a different situation. Now, somebody earlier said that they do their trade as long as it expires before the earnings announcement. Good answer on that one, by the way. That's absolutely true. You never want to have a vertical spread over an earnings announcement. But I've got an earnings announcement out somewhere in the May 24th-ish area. 25th. There we go. I'm going to use May 19th. I'm going to set up the trade in roughly the same way. I'm going to look for a 20 delta, which in this case is 270 strike. In fact, hold on a second here. All right, we're moving too many pieces at once, but I'll do it this way. 270 strike. I'm going to go short on that. And I'm going to go long on the 265. Now, this is a $5 spread as opposed to a $2.50 spread. So we're getting a little bit of a different game here. We have 80 cents in credit that we're receiving on this against a $5 spread. Now, $5 minus 80 cents means our margin on this is $4.20. 80 cents divided by 420, we're making 19%. Now, a couple of things to think about here. First of all, I'm a little stuck. I can't give you an apples to apples comparison. If I had a $2.50 spread, here's another good thing to understand is the tighter the spreads, the more leverage you have in the trade. You crank up your leverage, you make a higher return on investment for the amount of money that you are putting into the trade. But the total credit you're receiving is dropping too. So it means that the trade is more affected by the commissions that you're getting because the total dollars you receive are smaller, but the margin for each of those dollars is even smaller than that. So what's happening is you're leveraging up your trade for tighter spreads, but the total dollar you're receiving is getting smaller and you have to buy more and more, and your commissions affect you more. You go for a wider spread, in this case a $5 spread instead of $2.50. And the leverage on the trade goes down, but the total credit on the trade dollar-wise goes up. It's basically less of a percentage, but dollar-wise, you're getting a greater amount, and the amount of commissions hurts this number less because your commissions doesn't change based on the price of the trade. It changes based on the number of contracts. So we'd actually take fewer contracts to make the money that we're doing in this. It would cost us less, and that could actually work out to be a slightly better trade. Now, the reason I said that is I normally would be doing what I'd call an apples-to-apples comparison, which would be a $2.50 spread on one date versus a $2.50 spread on another date. I can't do that in this situation because of what we've got for prices and strikes. But we are now making 19% return on the trade over 37 days. So let's see what we're making per day. I'm making 0.5% per day on this trade. Now, right off the bat, we were being paid 2% a day to take the other trade. We're being paid 0.5% a day to take this trade. Everything you do in options is a trade-off of risks versus returns. Am I controlling my risks? And what is the return I'm getting for that? 0.5% a day, first of all, isn't a bad thing. So it's only making 187% per year. I wouldn't complain about that too much. But the strike that we're taking, the short strike where the trade really starts to fail, is at 270. So if I go back to the chart, instead of having a 277.50 strike, let's see here. I've got a 270 strike. Now, who here thinks that we have better odds of this trend continuing on and keeping us going up if we basically just have to avoid this line down here versus this line up here? Now, to be fair, I need to add in one more piece to this. Let's see, the expiration of this new trade is May 19th. So theoretically, we have to get from here to here while staying above this line versus here to here staying above this line. But I'll show you in a second why that's not actually entirely true. So what we did by going further out in the future, we gave up a little bit of our return on investment on a daily basis. Some, but we're going to adjust that in a second. But we got a lot more space for the trade to be successful. In fact, we're kind of below a bit of a support level here. We haven't really solidly been down at this level for quite some time. We've got a lot more room for this trade to work. The point here is that a quick little move down, just maybe a market twitch or a bad day in the market, or I don't know, a politician says something crazy, not that would have anything like that happen these days, isn't going to knock you out of the trade, isn't going to force you to the point where you've lost so much money that you hit your eject point, you have to close. You've got more room. Even if this fails, it fails slower. Now, getting back to the making 0.5% a day versus making the 2% a day, I would absolutely love to make 2% a day, but that's not really what you end up with at the end of the trading year, because sometimes those 2% a day trades that are very aggressive and are very, very risky, they fail, and we lose some of that. So that degrades that profitability over the long run. The other thing is that we basically, to make that 2%, we've got to leave it on to expiration. We don't need to do the same thing on this longer trade. Because the credit that we've received is so much higher, it actually gives us the ability to set a profit target to potentially close the trade out when, let's say, that it hits 10 cents. That means that out of the 80 cents that we got for credit, we kept 70 cents. If I was able to do that, say halfway through the trade, I actually am making a far greater return per day than I was going to if I've left the trade on all the way to the very end and let it expire. Now, I will have a couple more cents in commissions. That's true. But what's interesting is that as the price moves in the direction that we expect it to, it's actually accelerating our profit. So we are going to get to that profit target on the trade far earlier just from the price movement. So if we believe the price movement is generally heading into the direction we want, we can absolutely use that to take a safer trade with more room that fails slower and still get a very, very high return on investment per day on a trade that doesn't necessarily look as good right out of the gate. I would actually rather take that trade than take the super short-term trade. With a little bit of a plan to exit the trade, I am going to walk away with a very good amount of money, maybe not 2% a day, but let's say that we're going to hit a little over 1% a day for a far less risky trade and a far more controllable trade. I like those. I like that trade-off. Now, let's break this down for a second, though. Trading isn't about doing exactly what I tell you to do. Trading is about understanding what's going on and figuring out how it works for you. So what you need to do is figure out what kind of a trader are you. If you are a really good short-term trader, working day trading, sitting in front of your computer every day, the shorter-term trade may actually give you better results over the long run. You will get more money out of that. If you're a good person at making sharp, fast decisions, in and out, don't take much slippage, control your trades really well, the short-term trades might fit you. On the other hand, if you feel like going out and having a golf game once in a while, would like to go see some friends for lunch, and don't want to sit in front of the computer every day, the longer-term trades actually fit you better. They're slower, they're more controlled, you don't have to stay right on top of them. You've got a lot more ways of managing the risk. it's a trade-off. It's never a yes or no. It's what works for you. We want to find a way of managing your trades and your portfolio of trades so that you basically build a system around making money in your way. There's a whole bunch of variables here. There's a whole lot of ways you can do that. So hopefully that gave you a couple of little ideas on vertical spreads. Let me see if I can answer some of these questions. Once again, I'm getting a ton of these things, so let's see. Alan, the option selected is at the edge of the expected move. In a lot of cases, it's hard to say what the expected move is. Like if I were to look at this trend, my expected move is up. The option that I'm taking is not necessarily at the edge of that. Let me jump back to the deltas again, and let's talk about that. Delta is a measurement of risk. So if I use you might have noticed that I used 20 delta to select my strike on both the longer term trade and the short term trade. What I was doing there is actually putting together two trades that effectively have the same risk, or at least the implied risk based off of the options price. So I'm keeping things stable. But once again, that's not necessarily the only answer. I choose a 20 delta because that represents a certain amount of risk and a certain amount of control over the trade that I actually am comfortable with. I know that the majority of my trades are going to be winners. I'm not going to make as much money as if I had done a very, very high delta trade, but I'm not going to have to manage it as much. I'm not going to have it fail as much. It's not going to cause me losses. It's not going to cause me pain all the time. Therefore, I've settled in with a 20 delta. If I were to go out and have a lower delta, I actually have a higher probability of success, but I'm going to get paid less. I'm going to make less money. So we want to find a kind of a sweet spot. I know some people who get very, very aggressive. They go 30, 40 delta. Well, that's putting your strikes very close to the price of the stock, and it is basically exposing you to a lot of risk. You could make more money that way. The return on the trade is going to be higher that way, but you're going to fail more often, and the trade is not going to work more often. So what's going to happen is you're actually going to increase the variability of your returns. The swings between the highs and the lows are going to get bigger. In the long run, if you're more aggressive, you might make a little bit more money, but it's not going to be a significant amount more. You're going to make a bit more because the losses will be more common, the wins will be bigger, but you're going to be losing a lot more on the way. On average, you're not going to make a heck of a lot more than the trade with a lower delta and less risk. So the way I typically approach the strikes is picking it out by delta. And once we get into the class, we've been going for an hour and a half here tonight, so I do need to wrap this up.
Yes, always you do. You always under promise and over deliver, Doug, which is a great characteristic, by the way.
Yeah, I know. I catch myself on this. I know that I go, but all right, I'm wrapping it up here. Let me see if there's anything else. Did that give you, let me see here, Alan, did that answer your question? Hopefully that answered some. There was another question about iron condors. Iron condors are another full class all by themselves. They're in another set of trades that are really fun to do. They're actually very similar to vertical spreads, but I'm going to leave that one a little bit of a mystery because we'll do that on a full iron condors night. Let's see. Would I really put that trade on? Jackie, if you want to find that out, come tomorrow morning. I will be analyzing this trade in my ALTB at 9:30 in the morning tomorrow, and we will make a decision. And you'll see the whole trade plan and everything at that point. I can't tell you the answer with the market closed and spreads being stupidly wide. So,
well,
sorry.
And by the way, Doug, I got my spooks. I got all my intel sources. Apparently, North Korea's moved a potential nuke into a mountain, and they have promised something big on Thursday, which is the anniversary of, I think, his dad or his grandfather's death. So guess what, folks? Tomorrow might be a huge day in the market, so you're definitely going to want to, I think the SPX bear put spread I put on the other day, the SDS bullish double vertical we looked at today might be pretty good. But I'll tell you what, Doug, if you throw me back the control, you can scroll through some of the questions, and you can answer them maybe after I do a slide update here. So why don't you throw me back control, and then if you guys have any last-minute questions for Doug, throw them in there. Give me about 5 minutes, guys, because I think I wrote down 4 or 5 people who I tried to welcome aboard in the chat box there, who grabbed their slots. So welcome aboard to all those folks, and couldn't be happier. We have like a defensive and offensive, and a couple maxes there. So let me show you my screen. So Doug will be back maybe in about 5 minutes. Remember, folks, Doug and I do the demo do. So tonight, great vertical spread training. Like Doug just said, Jackie, you're currently a member, obviously. You'll be tomorrow morning. Everybody will be here. That's why we need to cut out here in a little bit. 0900 in the advanced live trade brief. So this slide is wrong. Sorry, I've been looking at 50,000 things, folks, from what Putin said to Rex Tillerson and North Korea and what China's doing. There's a lot of crazy stuff going on, man. So get ready for some volatility. So this slide's wrong. I think it's 38 or 36. And I know the phone's ringing right now, so because I gave out the phone number to a couple people who had some questions. So, folks, the slots are going. We talked performance throughout the week of the primary live trade brief, the urgent alert, and weekly options. The weekly options service, folks. Yeah, I don't want to jinx myself with a nuke tomorrow and our SPX iron condor gets blown out, but it's absolutely crushing it. A 92% success rate on our weekly options trades year to date. That's a career high for me. And then AR, accelerated retirement, there's my embarrassing portfolio with that gain. So again, these are testimonials. My marketing guys throw this stuff together. Somebody said earlier today who grabbed the slot, like, hey, man, you don't have to do all this stuff. Everything speaks for itself. And there's a couple people, and I know Doug feels the same way, who are like, oh, well, can I have a trial? You got your trial, folks. That's why we open the squadron for a week. There's your trial. We don't do trials, folks. We open a squadron for a week, and you either get airborne with us or you don't, and you miss out. So, so full throttle, I explained it this afternoon. We have 3 tracks. If you're an aggressive trader, you want to stick the fangs out of your face mask and go after the market and take shots of opportunity, we got a track for you. You want to throttle back a little bit right now? Hey, man, I want to keep my powder dry a little bit or put on some hedges or some more conservative trades if World War III is going to come. Well, and guess what? We obviously have a package for both of those. Wiz, I want weekly options, I want the retirement service, and I want everything you and Doug do. Well, guess what? We got all of those. My portfolios I manage, weekly options, primary live trade brief, AR, which we did this afternoon, and the urgent alert service. I usually send mine out on Thursday, but I did it on Tuesday with that VXX trade just because of our condensed week. Doug, he does the ALTB tomorrow morning at 9, and then he also does the advanced trade alerts. He sends them out whenever he sees them, but usually he knocks all his stuff out on a Thursday. He also runs a program called Wingman Group Coaching. Not even going to get into that tonight. Down the road, after you got some airspeed over your wings, you're going to want to look into this kind of a small group coaching program that Doug does. One-on-one with you, and then also as a group. It's kind of like a mini hedge fund. It's awesome. More on that down the road after you become a member. So it's time for you guys to choose the right track. If you like that offensive track, you like weekly options, you like the fact that last week 3 shots, 3 kills for $5,300, already paid for your annual membership into the max slot, yeah, then you want to do the offensive track. And that's you gunning the brains out of an F-22 Air Force jet in your Hornet. A little bit more defensive. You know what, Wiz? Not ready for weekly options yet, but I want everything you guys do. And instead of weekly options, I'll take accelerated retirement. That's the track for you. A little bit more conservative. There you are in your E2 Hawkeye with that radar looking out, a little longer range. That's called the defensive track. And then, folks, if you want to go max afterburner and get everything we do here at TGO, you want to do this one. That's the max afterburner track, and that's the link right there. Go.topgunoptions.com/getft. Okay, and that's you, man. That's a beautiful, even though It was the flying tennis court. That's an F-14 Tomcat right there at a Sunset launch in full afterburner, man. I've been sitting right there next to that thing, and you can't even feel your heart. It changes your heart rate. So that's going to be you getting airborne, hopefully looking at max profit. Remember our last member survey, 80% of you guys work. Remember, you don't have to attend the sessions live. They're all recorded. Doug and I send out text alerts immediately during the live trade brief. When I get a trade, copy, paste, fire. So you get it a second or two behind the people that are sitting there live. Ain't that big of a deal. And then we send out the emails afterwards. Takes Doug and I 20 minutes to go hit the head, grab some coffee, and then type up our email after live trade brief, and it's pretty awesome, okay? And obviously all the adjustments are sent out via text alerts or emails as well. So, and like Chris, said a couple weeks ago, I'm so geeked, Wiz, I've been a subscriber for 3 years now, and this is the first time I've seen you live because of my work schedule. I only know you via the replays. And he absolutely crushed it just like everybody else. So don't worry if, hey, Tuesday mornings I'm in death by meeting, Wiz. Great. Doug and I can run our entire portfolios off of this. We can send out text alerts. We have our options house or Thinkorswim or whatever platforms on here. So you don't have to be tied to our live trade briefs to see success. And obviously making you the Don Corleone, as the senator from Nevada said before he woke up in a whorehouse drunk, an offer you can't refuse. You get all our manuals, the primary, intermediate, advanced right there. That's about $400. And then you guys got the OPCL. Remember, folks, listen to me. This is a big one. You are grandfathered in at this annual rate. Based on our performance, the prices should go up in 2017 unless Doug and I hit our heads and we become complete idiots, which hasn't happened in 7 years, so I doubt it will. So you're locked in at this rate. We have people who did full throttle in 2010 when we got airborne for like $500, and that's their annual rate. So it's going to go up. So 3 years from now, when you're a member and you're laughing at other people having to pay 6, 7, 8 grand, enjoy it, okay? And remember, as long as you're a TGO member in good standing, you get Doug or mine's training every time we do this. If we do a full throttle again in 3 months, you get to attend Doug or mine's training again for free. We charge $495 just for the academics. So if we do that 3 times a year, that's $1,500 right there, folks, in added value that we're going to give you. Okay? So no catch. The only catch is by Friday when we close the doors, we're probably going to be full. Okay? So we'll have a special announcement on Friday if we don't have all 50. So make sure you attend the weekly options brief on Friday and write down this number if you have any questions, concerns. Oh, by the ways, it's 754 300 1084. I'm going to leave that up there for a second in case you're scribbling furiously to write that number down. Or the easiest thing to do, folks, is shoot us an email, support@topgunoptions.com. Now, I know many of you were waiting like, all right, Wiz, how the hell can I buy an annual membership if I haven't even met your guy Doug yet? You just did. And you can see he's a hell of an instructor. He's just like me, folks. He would, if I didn't jump in, he'd be here till midnight. That's a good thing. It's a bad thing when you're marketing. It's a good thing when you're in the course and Doug sits here in his full throttle sessions. Whoever was asking about an iron condor, look down here, folks. Doug's session 5 is about an hour and a half to 2 hours on iron condors. And you can ask 50,000 questions until you're blue in the face. He ain't leaving until you get it, okay? And if you don't, you can jump in the ready room and ask him or me or your fellow members about iron condor. So this is all the training you get, folks. It's on this page, what you get, and you get it for the rest of the time you're here at TGO. And like I said, it's a $495 value. So that's shit hot. So there's your tracks, guys. $19.95, and these are annual. I love, somebody asked me in the chat box again tonight, like, are these monthly? I should have said, yeah. These are annual. So one trade last week I covered, or 3 trades I covered a year and a half. My Iron Condor on the SPX last week alone made $3,300, and then the Goldman Sachs and the SPX bear call spreads made $2,200 a piece. So nearly an offensive track, folks. And Doug will say this: men lie, numbers don't. Showed you the trades. They're on my slides. I'm not going to kill your slides. So we can drag you to water, but we can't eat you a drink. So for those of you that are waiting to grab your slot, if you want to see Doug in action tomorrow morning, 0900. Even if you're still on the fence, you got to come to the rest of these folks because we're going to do weekly options on Friday as well. So, yeah, JD, yes, I just said that about 4 times. We are doing the weekly options brief on Friday. We're still doing the brief, folks. I know we can't fire trades. I'm not, Yosoi non-caveman. I get it, folks. We're still going to do the brief, as in talking about our slots. Doug and I are going to debrief the week, folks. Whenever you get done with a mission, folks, you knock out a debrief. That's the problem with other services you've been at. They don't knock out a debrief. You need to come Friday at 1 o'clock and say, hey, Wiz, this is what rocked this week. This is what sucked. Or, Doug, I have a question about this trade. So it's about a 20 to 30-minute debrief, and then I'm going to cover our weekly option service, and I am going to look at potential trades for the following week. Even though we can't fire them, we're going to talk about what I am looking at and my weekly options mentality, okay? I sent out a trade on Monday to my weekly options members, so we'll debrief that one too. So I know the market's closed, but still attend. Okay, so that's what we're doing. Joseph, good question. After you join the defensive track, can you upgrade? Yeah, you just pay the difference, Joseph. A lot of people do that who are dipping their toe in the water. They do the defensive track first for 2, 3, 4 months and go, okay, I got it. I got my my airspeed over my wings. Let me shoot an email to customer support and upgrade. You bet, man. You can go, JD, from defensive to offensive to max, and that's what a lot of people do. So good question. Thanks, Chris. I appreciate it. Good. Having liquidity problem here. Hey, man, no. Go with the defensive, Joseph, and then give it a month or 2 or 3. Hopefully you won't have a liquidity problem, knock on wood, and you'll be able to upgrade to a max or an offensive in hopefully a short time. Like I said, folks, this is, as Doug was talking, I tried to pay attention, but, man, there's you know, Google came out and said our #1 search for the past 2 days has been World War III at the highest peak ever. China reportedly tells its military to be ready to move to North Korean border. China warns North Korea's situation has hit a tipping point, threatens never before seen measures. So it sounds like Trump has given them a little bit of a break. He said today, I'm not going to label them a currency manipulator. Don't beat me to YouTube, guys. I've already watched it. Of course, he said during the campaign, within 100 days, he's going to label him that. He's a negotiator. So I can't wait for all the libs and Democrats' faces to melt off like, oh, my God, he's flip-flopping. Folks, if you didn't know that this guy's he's in real estate, man. You hit him with your opening broadside. You don't hit him with your mid-market offer. That's ridiculous. He broadsided him like, I'm gonna smack China around. Holy crap, I got to deal with North Korea. I'm going to give you guys some of this if you sit on your little cousin and you know, pinch his arm. So all the stuff I read tonight, and I do get some emails from people that you will never know, that there might be a potential nuke light off tomorrow. So thank God you were in the PLTB on Tuesday and got that hedge on, or today's accelerated retirement and got the hedge on SDS. If that happens tomorrow, folks, you'll see the Dow down probably 500 points if he lights off a nuke. Easily. Okay. Rag who? I didn't attend afternoon session. How can I watch the recording? That means you haven't attended all the other sessions either, man. Here's the replay page. You ready? It's really hard to remember. It's it's go.topgunoptions.com/FT-replay. So Raghu, sorry if I'm getting that wrong, man. Mr. Thoda, maybe I'll say your last name. That's the link right there. Everybody get that? I'll put it in the chat box too. You're welcome, my friend. So you can watch, as you can see, as soon as I get done yammering here and Doug maybe answers 1 or 2 final questions, I'm going to render this recording and I'm going to post it on that page. This will be posted tonight, so if you join late and you want to watch it tonight, great. But I recommend you go get some shut-eye, and I got to cut Doug loose because he's got to prepare for his stuff tomorrow morning. So Doug, over to you, man. Any last-minute questions? Oh, by the way, is there anything you want to cover?
Yeah, actually, you know what? We have Rick S. out here who's put out a bunch of interesting kind of comments about Iron Condor's something. I'm not going to go there. But it's interesting. I always love to see somebody who has such a harsh opinion about a particular trade, because I've got years of profits in Iron Condors that say something else. You know what? There are good times to take trades. There's bad times to take trades. They are going to stink if you don't take a trade at the right time. There are good conditions for certain trades. There's bad conditions for certain trades. Just deciding that something is a terrible idea is probably a terrible idea all by itself. I love seeing those because it's honestly, I flat out feel that it's wrong. You haven't learned what you need to learn to make the trade work.
Well, Doug, you know what's funny is when you only have a hammer, you know, everything looks like nails. So I'll tell you what, folks. Back in look at this chart, the S&P 500. December and January, except for this Kwanzaa, winter solstice, Christmas, can I say it, pullback, where like 3 guys were trading on the floor and there was 100 shares traded, whatever. This entire time, folks, in my portfolios, we printed money trading iron condors. I knew, so here was I call this a hope and change rally, right? Here's the hope rally, like, holy crap, this guy won, pro-growth, cut taxes, infrastructure spending, gutting Franken-Dodd, yay! And then I said, we're going to level off until what? What was right here? The inauguration. So whoever said iron condor sucked, man, what were you trading during this time? Well, I was selling bear call spreads. Okay, what else could you have been doing? Selling bull put spreads? Well, Einstein, you put those Reese's, peanut butter and chocolate together, you get an iron condor. So I get that maybe you got burnt a couple times in another service or on your own with an iron condor, but you have to use the market appropriate tactic for the market. Ladies and gentlemen, if I haven't said this week, write this down. Here's another wizism. You trade the market you have, not the market you want. So if you're only well-versed in trading iron condors and you got this type of crap going on here, or this rip-your-face-off rally, you're going to get obliterated. Yeah, I made that word up. So I read that comment too, Doug. So whoever said that, man, sign up here. I showed you this week in my briefs, and Doug will pull out his stuff tomorrow morning, that, hey, man, I was cautiously bullish, but as I sit here and read my intelligence reports and watch hockey, this guy lights off a nuke. We have our hedges ready to go. Our longs are going to get hit, but we're going to take the profits from those hedges and put it back into the longs. So even though I was trading X, Y, and Z tactics here, in the blink of an eye, we can go bullish double verticals or bearish double verticals, guys. That's why we're options traders. We don't give a shit if the market's going up, down, or sideways. It's going somewhere. Pick the tactic out of your toolkit that's going to help you profit. And Doug, in his infinite wisdom, that's what he's going to teach you in these things. Hey, maybe right now it's calendar season, man. Or maybe we've settled down, it's iron condor season. Whatever it is, Doug's going to give you that training, okay? So does that make sense?
By the way, Wiz, right now, if we do have a mess tomorrow, I've got a VXX bull call spread that is set to make a ton of money.
Bam.
So
perfect.
It's what it was there for. It's exactly what it was there for. If something hits the fan, then it protects the rest of my portfolio by making a huge profit. So we'll see. I don't know. I'm not looking forward to having a nuke go off, but hey, we'll deal with it if we've got to.
Exactly. And see, folks, I love doing a full throttle open house when it's a week like this, where it is a little worrisome, because it shows that you have to be hedged. And Eileen, you just asked a question. Was SDS trade like an iron condor? It's not even close to an iron condor, Eileen. You have got to watch this afternoon's replay from Accelerated Retirement, or the urgent alert trade from yesterday right here. So a double vertical, Eileen, is the exact, an iron condor, you think something's going to stay range bound. A double vertical is the exact opposite. So Eileen, this is to you. I only do a double vertical if I am really, really, really something. Not 2 reallys, not 1, 3. So if I am really, really, really bearish on the market, I could do it. It means, I call it an afterburner trade, meaning it's 2 vertical spreads just simply on top of each other, okay? So Eileen, since you asked that question, you have got to watch the replay, especially now. Even if the world, if he doesn't light off a nuke tomorrow, folks, the fact that that's out there, and that there's going to be a resolution to North Korea, period. It sounds like just north of me and south of Doug, in between us, when Trump met President Xi, he gave a little concessions on trade and stuff, and he softened his rhetoric in exchange for China sitting on this guy. But even China, and Doug knows I got some deep throats in D.C., people are terrified of this guy, folks. First of all, I told you the other day, and I'm not joking, the intel communities think he has syphilis. So he is going a little bit crazy. When you line up a bunch of your generals that you think might be traitors or looking at you weird, and you blast them into hair, teeth, and eyeballs with anti-aircraft guns. And previously, he used to just use dogs that hadn't eaten in a week, and he'd throw them in a pit. One of the defectors last week told Lester Holtz, he's like, you guys really don't understand what you're dealing with. So I think China is even telling Trump, like, hey, man, he's him. we don't want, if something happens, we don't want 4, 5, 10 million North Koreans streaming across our border, man. China's always liked having that buffer, North Korea between South Korea. What's South Korea? It's freaking capitalism, man. You go to Seoul, it's yay. They don't want yay up against the Chinese border. So this is a very precarious moment, folks. I've told you guys this all week, and I'm going to hit this drum again. We're in this 50-day here, man. If we break it, I'm not even going to throw a dart and say where we're going to bottom out here, but I am going to say this is trench warfare. There's the Allies in World War I. There's the Germans. Ain't nobody living between the 50 and the 200. These are magnets, guys. So if there's an event that blows us through the 50 with airspeed, that's it, man. We're going to kamikaze and pound the hell out of this market into the dirt. And then when it rebounds, or we're not going to pick a bottom, but the Goldman Sachs, the JP Morgans, the Apples, the stuff that is going to take a hit but ain't going out of business and will be rebounding in a year or 2 years, we'll get long, man. So this is a great time to be here at TGO. I don't like the uncertainty as an American. I love the uncertainty as an options trader. And remember, I jokingly say I wear, and Doug does too, we wear 2 suits at Top Gun Options. He wears his Army BDUs. I wear my flight suits. So as Americans, we'll tell you how we feel about crap that's going on and how it sucks. But at the end of the day, we throw our business suits on or our trading jackets and go, I don't give a shit. As a portfolio manager, I am going to go long China or long Russia or whatever it is because we need to make money. So two different suits, guys, and it does suck sometimes. I call them hold your nose trades, but I am so glad we're doing full throttle this week. Kurt, skeptical when I joined as I have been burned so many times. Not skeptical anymore. Making money since I joined in February. Thank you. Thank you, Kurt. And it's funny, I'm going to take a screenshot of that because I'm not just sitting here reading that. So when I take a screenshot, everybody can see that Kurt just said that at 9:57. So thank you, Kurt. John, where are they going to aim the nuke? I missed that. They're not, John. If you search it, where was I seeing it? I saw it on a couple Washington. I'm still a member of some DOD websites, and it's in a mountain. They've in one of their nuke testing sites, they've seen activity putting big stuff into a mountain, which is signs of a potential nuclear test. And they've prepped the battlefield for this, folks. Google it. For the past week, they said something big was going to happen on Thursday. I forget, guys. Again, I'm reading way too much here, but it's either his dad's birthday or the anniversary or something, and they usually do something big. So get ready to this. JD.
I think it was the anniversary of the day that he captured that unicorn that he has a picture of. Something along the lines there, but.
No, JD says, I stepped away for a second. I hear you talking about a nuke. I thought you were joking, but you're not, correct? Guys, I'm not joking. Google it right now. I'm looking on my breaking sites. Again, I told you guys, I know the CAG on the Vincent, and they're off Korea. He stopped responding to my emails a day and a half ago. So let's just say that, guys, this saying, and even Trump said it tonight or today in an interview with the Wall Street Journal. He said, hey, it's just not the Vincent Battle Group that's over there. I got subs sitting there as well, folks. And this is going to end. Doug and I aren't going to be talking about this in 3 months, guys, North Korea. So how does this end, folks? If you think it ends with cream of some young guy saying, you know what, I'm going to give up the nukes, you got me, or do you think this is going to turn nuts? If you think it's going to turn nuts, you need to be here at TGO. All right. One more thing, and then we'll get going because I got to get you guys. Steve, what's this say? In a striking development involving the North Korean moments ago. Here you go. Yeah, that's the report I read, Stephen. Thank you. I'll read this to everybody. And it's funny that a lot of people say that they get their news from TGO. That should be our tagline, Doug. They're like, we get our news from you guys. Voice of America reported that, according to U.S. government and other sources, North Korea has, quote, apparently placed a nuke device in a tunnel, and it could be detonated Saturday a.m. Korea time. In a striking development involving the rapidly changing North Korean geopolitical situation. Yep. Wow. All right, guys. Well, I got
you mind if I jump in on this one for a quick second?
Yeah, go ahead.
There's a little background on this too that people have to keep in mind. Kim's political situation in North Korea, they've been basically getting more and more information that it is basically falling apart there. He's got a lot of people inside his own country that don't like him. And, he's been trying to fix that by basically killing the people that that don't like him. But it's building up and building up. And one of the best ways for a dictator to keep power is to create a crisis that is, something like this. So I really wouldn't be surprised to see this is not just a response to outside Korea, but this is a response to his own situation inside Korea. I'm not terribly surprised at this.
No, and Doug, you're exactly right. If you were that guy and you saw Saddam Hussein at the end of a rope, and you saw what happened to Gaddafi with no lube, so to speak,
right?
And what just happened to Assad, and Trump's the guy that says, "Hey, China, you either fix this or help us with it, or we're going to do it." If you're that guy, and you do have about 4 or 5 nukes, what do you do, folks? And Doug and I aren't trying to scare the shit out of you, but as 2 former military guys and options traders, we are trained to look at what is the worst possible thing that can happen, and are we prepared for it? And if we are, okay. If not, man, if you don't place the trade or you don't get involved. So again, if my hedges that I put on this week, quote, lose money, first of all, you guys know my mindset. I don't lose money on a hedge. I lose money on a trade. I don't lose money on a hedge. I'm going to go sleep soundly like a baby tonight knowing that I have a hedge on. Not sounding like a baby as an American, because this is bad. I got a lot of buddies in the Vincent Battle Group. Doug's got a lot of Army buddies in the south of the DMZ. There's rockets that can hit Okinawa, that can hit Guam. In the past, in my entire military career or in my adult life, this is the closest we have ever come to another war in the Korean Peninsula. And somebody just asked, how do you guys seeing it end? I got to be honest with you, man. You guys can read what I read. And Doug knows I speak at a company where there's a lot of former operators. I have a lot of SEAL buddies. This is searchable news, so we can talk about it. There's a lot of SEAL teams. This is not public, but you could probably deduct it, that are being asked for a, hey man, this might be kind of the one-way mission type of thing. Let's just say that that is part of it as well. Maybe a couple SEAL teams. This guy's going Saddam Hussein right now. He ain't sleeping in the same bed 2 nights in a row. He's moving around constantly because we might be landing some operators in there to take this guy out, and these people might have signed up for a one-way mission. So guys, again, hell of a way to, let's end on a high note, but we're options traders, guys, and again, wearing my flight suit and Doug and his BDUs, this sucks. We've been on the pointy end of the spear. I've been on the Carl Vinson. I've sailed off of Korea, and I know what this feels like. As an options trader, man, we as Doug and I have to look out for you and our portfolios, and that's our number one priority. So, Doug, I'll let you wrap up, and then I'll close the room, man.
Yeah, I'm pretty well set. If anybody has any questions, I mean, on this Korean thing, all I can say is that from experience, there's nothing cool about bullets flying. Not excited about that, but I don't see it terribly ending well. We've got a nut job who's backed into a corner, and that's it. I mean, that sums it up. We've got a guy who's got no options left, and he's got nukes. Yeah. That's not a good situation. Well, let's see. We'll see what happens.
Yep. All right, guys, everybody give Doug a big golf clap, a big virtual round of applause like at the Masters. Doug's a hell of an instructor, guys, and this is just a sampling. This is why we do the Wednesday night training session. This is a demo of what you're going to get in the full throttle training. Doug and I usually, we do our normal week next week, but we throttle back from this incredible week that we've had. He'll probably start his training in about 2 weeks on a Tuesday night at 7, and this is what you get. So appreciate all the kind words you guys are typing in there for Doug. Hell of an instructor. And like I said, if you hate that Iron Condor, whoever typed that, maybe you let Doug teach you how he does it and how we do it here, and he'll help you out, okay? As I was talking, I think an annual offensive slot went because my phone buzzed. So again, guys, here's the link to our sales page. go.topgunoptions.com/FT-now. Let me make sure that link works here. FT-now. And then it switches to like get FT or something sometimes. But okay, so that's it. All right, I'm going to go. Doug, you're cleared off. Folks, we'll see you tomorrow morning at 0900. I'm sure some slots are going to go overnight because I know some of you did say, hey, well, I got to see this Doug guy before I make a decision. You just saw him. If you got to see him in action live in the market, you're going to see that tomorrow morning at 0900. Okay, so grab your slots tonight. Thank you, Wayne. Go ahead, Doug.
Oh, hey, one quick thing. Just want to let anybody know, we do a lot of earnings trades. Tomorrow morning, if we haven't had a nuke go off, we're going to have a different class if that happens. But tomorrow morning, I'm going to be taking a look at some earnings trades. And so they're really interesting trades. A lot to learn about them, a lot of fun, and we've got a whole earnings season that's coming up.
Yep.
This looks like one of the biggest earnings seasons we've had in literally years, like since 2011. So might be an interesting one to stick your head in. See you then.
All my members have known for the past 4 or 5 or 6 quarters, earnings have sucked. I think they're gonna. I think we're gonna see a very, very strong crew on. We got J.P. Morgan coming out tomorrow. I know the financials have been sucking a little bit lately. We'll see what Jamie Dimon has to say tomorrow. But guys, if you haven't, you got to watch the replays, guys. If you do not have an SPX bear put spread on, or the SDS bullish double vertical. Now, if you're sitting there going, okay, why is Wiz putting on a bullish double vertical if he thinks the world's going to end? Folks, that's SDS. That's the ProShares Ultra Short. So if the market implodes, SDS goes up. And this bullish double vertical will print money, unfortunately, or fortunately, depends on if you're wearing a flight suit or a business suit, as a hedge. So watch the replays, guys. And I'm not kidding you, man. Doug and I suck at marketing, and I'm going to get debriefed tomorrow by my marketers about how much I suck. But this is why we open the doors, guys, so you can see what we do. And in a week like this where things are crazy, I showed you what happened last week from Susan Wright hopefully getting 10 years in jail to us firing missiles. And a crazy week last week, we made money. So that's it. All right, guys, everybody's cleared off. Take the rest of the night with pay, so to speak. And Doug and I will see you bright and early tomorrow morning at 0900 Eastern, and you'll get a reminder link at 0800 so you can log into the room, okay? But once I close this room right now, I strongly recommend if you're on the fence and said, oh, I needed to meet Doug, you just met him, grab your slot, because after I close the room on Wednesday nights, we usually get about another 10 to 12, maybe 15 full throttle slots to go, okay? So thanks again, Doug. I'll see you tomorrow morning at 0900 with a cup of coffee, my brother. So have a great rest of your night.
Sounds good. See you then.